I have made many mistakes in my investment career, but this is by far the most costly mistake I have ever made. And I'm sure many of you guys, if you're starting out in the market, especially if you're a value investors like I started out, you will likely experience the same things I've experienced. So if I can help one or two people, or a few people at least, avoid the same mistakes that I made, which is a very costly one, I would be very, very satisfied. And if you do enjoy this video, all I'm asking is please press the like button and let me know what you think in the comments. And this mistake mainly started after I read a very popular book called The Intelligent Investor. And I always say I wish I never read the book because it has caused me more harm than good, and it has massively damaged my returns if I think about it for the long term. But in the Intelligent Investor book and in Benjamin Graham's strategy, his strategy is to buy stocks below fair value, below the intrinsic value. Once they get fully valued or they become a little bit overvalued, he sells them. Then he takes the proceeds and he buys another stock that looks undervalued. Maybe this is a strategy that you implement, and it's a very good and very rational strategy. And it's a strategy that I implemented for my first 6 or 7 years of investing, and I actually found a lot of success implementing the strategy. Now, the mistake I made, and this is the mistake that most retail investors make, is they apply this strategy to a lot of amazing quality companies. So the Benjamin Graham strategy is meant to work for dying textile businesses, for turnaround kind of stocks that have little to no revenue growth, for non-quality companies. But the mistake I made is I took this approach and I applied it to companies like Apple, and to companies like Google, to many different amazing high quality companies, and I sold them because they reached fair value, or I believe they were overvalued, and then they became more overvalued, and I missed up on a massive, massive runs, hundreds and hundreds of percent. And instead of me getting in and out of all those stocks, I should have just held Apple, and I would have outperformed all the returns I have gotten in all those years. Now, the main thing is, and this is a major realization we have to come to as investors, and something that we have to talk about on YouTube, is that no one really knows what the fair value of a company is. We might have an idea, we might have a range, but we don't know for sure what is the fair value of a company is. My fair value estimate is going to be different from your fair value estimate. It's going to be different from another YouTuber's fair value estimate. We all have different ways of estimating or valuing a company. We don't really know which way is the right way, but some of us have a better record of knowing certain methods to value a company where normally it's a good buying opportunity, and some others don't. But no one really knows the exact, absolute perfect fair value of a company. The main reason we don't know that is because we cannot predict the future. We cannot predict if the future is going to be better than we expected. In this case, we would be wrong on our valuation model, or if it was worse than expected, and we could also be wrong. So we could have a range, we could implement certain margin of safety measures, buy a small position, add a little bit later, but no one really knows what the exact fair value is. So selling just because it reached above our imaginary fair values that we calculated through a DCF is normally a major, major mistake. And this is something that I have done on many stocks, but I always like to talk about Apple, because Apple, it was an obvious buy for me in 2018, and I was not the only one buying it. Warren Buffett was buying it. So I was following the best investor of all time, Warren Buffett. And you could have followed Warren Buffett like I did. So I did follow Warren Buffett. I bought Apple at 15 times earnings into the 2018 pullback. 15 times. A few months later, 7 or 8 months, Apple was up 50%. The PE was around 18 and a half times. I'm like, okay, I bought Apple at 15 PE. It used to trade at 16 PE before. Now trading at 18 and a half PE. The stock looks overvalued. So I'm going to sell it and then buy something else. What happened since then? You can see the chart. Apple went from like $55 to $250 at its peak. And I missed on pretty much amazing gains with one of the best companies in the world. Now, the truth is, back then, I should have asked myself, is the business really getting better? So Apple's services business was growing in a major way. It was going to have more revenue growth over the long term, better margins, a better business in general outside of hardware. So maybe it deserved that multiple expansion that it was getting back then, and I should not have sold. just because the business got above my imaginary fair value number, which I calculated and I have an idea what it is, but I don't know for sure what it is. So for me personally, I came up with a few rules and a few guidelines of me knowing when I should exit a stock. And I'm not talking about a terrible company, but mainly a great kind of a quality long-term compounder. And the first one is when the stock becomes extremely overvalued. Now, I'm not saying slightly above fair value. So let's say the average P is 15, is trading at 17, 18, you sell it. Nothing close to that. For example, I still own Visa stock, okay? I bought Visa as 24 PE. Visa right now is trading at 29 PE. Now, extremely overvalued to me on Visa would be like 38, 40 PE. If that gets to 40 PE, then I would say maybe Visa is extremely overvalued. But at such prices, I could still come up with a valuation model of earnings per share growth that would not tell me that Visa is extremely overvalued. So I would not sell a stock if it's a little bit overvalued or somewhat overvalued, if it's an amazing company that continues to innovate and continues to improve and widen its moat. But if it gets extremely overvalued, I mean a Costco-like multiple, and this one has defied all rational expectations, then I would probably be a seller. So only if it gets extremely overvalued. The second one is whenever the fundamentals are deteriorating, and this is a little bit hard to quantify and for me to tell you how it is, because each company is a little bit different. But I'm going to give you a few examples. The first one, let's say, is with a growth company. The most important metric is growth. And once growth starts declining in a major way, this is a sign that maybe the company has peaked in terms of its growth trajectory. And you could have looked at the same thing with Celsius, or even, I would say, Elf Beauty, actually. But even Celsius, but Elf Beauty. Elf Beauty was pretty much on every single shelf. It was well known. Everywhere you go, you see Elf Beauty. And the growth was declining. And you could have noticed that a while back, before the major pullback that has eventually happened on Elf Beauty. So to me, whenever I notice deteriorating fundamentals or something that's changing within my thesis on the stock, with a growth stock, I would like to consider exiting the position. The second one, if it's cyclical, I look for a declining backlog. So a lot of construction companies and other cyclical stocks have a backlog. Once this backlog, let's say, declines over 2 quarters, then maybe this is a sign that it's entering a down cycle, because they go through up cycles and down cycles. So that maybe it's the time for me to exit and move on. But pretty much whenever the thesis is no longer the same, and it's different with every company. The last one, which is a little bit hard to quantify again, but whenever the company reaches maturity. So in the market, we have a business cycle. Every company goes through this cycle. They all start as a startup, and they become pretty much mature companies. Some of them, they redesign themselves and they stay alive, and a lot of them, they die out and they go to zero. That's the truth of capitalism. Okay. Now, with a startup, it starts as an amazing company, it starts growing and everything. Eventually, all those stocks will reach maturity. Maturity normally is whenever the company is more focused on staying alive and on returning value to shareholders than on actually growing. Once a company puts this specific area as focus, then it reached maturity, and maybe it's time for another investment. Especially if you're not a conservative investor, if you want something that has a lot of growth, then maybe it's time to exit. For example, let's say a company was focused on growth, on innovating, doing a lot of things. Now the company is no longer innovating. They're doing buybacks and dividends, and they're trying to stay alive. To me, this is not an interesting company, and I want to exit as soon as possible. And maybe I can name Apple right now, which isn't really too focused on innovation, but doing buybacks and dividends, and it's really not the best place to be. I'm not saying it's not good to hold a great company that's not growing. I have some of them in my portfolio, but normally once they reach maturity and they get close to the decline, I want them either for a short period of time as a tactical bet, or I don't want to be in them, but I'm not going to be in, for example, Coca-Cola for the next 10 years. That's just not my kind of investment. So this is how I would decide when to sell. But the biggest mistake I made is applying Benjamin Graham's rule, which is made for trashy companies, and I applied it to amazing quality companies like Apple and Google and many of those stocks that I sold early before because they got overvalued. But the truth is, no one knows what the actual fair value is. We might have an idea. Some of us might be better than other people on having a track record with such things. And I personally did do really well on a lot of fair value numbers on Microsoft and others. A lot of you guys told me. But, no one really knows. And basing our entire thesis based on that one number and ignoring the business, how it's improving, ignoring everything else is a major mistake. And that was my message for today's video. If you're interested in more of such educational content, you can check out my Patreon. This is the link in the description. But thank you again, not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.